Hello, and welcome back to Forex School from Pip Insight. This course is the complete guide to moving averages, the oldest, simplest, and most misunderstood tool on any chart. Here's the roadmap. We'll start with what an average actually measures, because almost nobody stops to ask. Then the simple moving average versus the EMA, and when the difference genuinely matters. We'll unpack the famous 20, 50, and 200, and the real reason those particular numbers carry weight. From there, dynamic support, price riding a rising average, then crossovers and the golden cross, taught honestly, whipsaws and all. We'll finish with the average as a trend filter, a frank chapter on where this tool breaks down completely, and a full recap. Everything here is education and market study, never a signal service. Notebook ready? Let's begin. Strip away the mystique and a moving average is playground arithmetic. Take the last 20 closing prices, add them up, divide by 20, that's today's value. When the next candle closes, it joins the sum, the oldest close drops out, and the calculation repeats. That's the moving part, a rolling mean that walks forward one candle at a time. Its whole purpose is smoothing. Individual candles are noisy, wicks, spikes, single session panic, but the average irons those wrinkles flat, revealing whether the market center of gravity is genuinely rising, falling, or going nowhere. And note carefully what it cannot do, it is built entirely from the past. Every value on that line is history, averaged. Here's why smoothing matters. This market is pure chop, watch the candles whip about. The fourth candle drives down to 126.62, and the sellers look completely in charge. 3 candles later the seventh spikes to 127.40, and suddenly the buyers do. Panic, euphoria, panic again. Now the gold line, the average of every close in this window sits at roughly 127.02, and it would barely move across the entire chart. Every wick, every scary candle, is just noise oscillating around that value. The arrows mark the emotional extremes, the line marks the truth beneath them. One line, and a chaotic chart becomes what it really is, a calm, sideways market. Next question, simple or exponential? The difference is weighting, and it matters rather more than most tutorials admit. The simple moving average treats every candle in its window identically, 20 closes, 20 equal votes. The exponential moving average, the EMA, rigs the vote, giving recent candles more weight and letting older ones fade gradually towards nothing. The consequence is speed. An EMA hugs price and turns earlier when the market turns, a simple moving average is calmer, smoother, and slower to change its mind. Neither is better, they buy different things. Faster reaction means more false alarms in chop, smoother means arriving late to genuine turns. Short-term traders tend to favor the EMA's responsiveness, while longer-term traders often prefer the simple average's stability. Speed against stability, that is the entire trade-off. Watch the trade-off play out. 5 green candles climb steadily, and the rally peaks at 129.18 on the 6th bar. Then the turn, and it's brutal. Bearish candle after bearish candle, and by the 9th bar price is trading at 127.90. Now the two markers. The teal line shows roughly where a 20-period EMA would sit by that point, near 128.12, already bending down with the fall. The white line is the simple average of the same window, still up around 128.60, still technically rising, serenely unaware. Same data, same window, different weighting. In a fast reversal like this the EMA speaks 2 full figures earlier, and that is exactly why faster traders lean on it. 20, 50, 200. 3 numbers that every chartist on the planet is watching, and that fact is the whole point. Why those numbers? 20 periods is roughly a month of daily candles, the short-term swing. 50 covers about a quarter, the intermediate trend, and a long-standing institutional favorite. 200 approximates a full trading year, and it has become the classic dividing line. Financial television declares a market healthy above it and broken below it. Now the honest part, there is nothing mathematically special about any of these. 19 or 21 would smooth almost identically. Their power is attention. Because millions of traders, funds, and algorithms watch the same three lines, real orders cluster around them, and the reactions become partly self-fulfilling. The maths is arbitrary, the audience is not. Watch what everyone else is watching. Now the behavior that turns a lagging line into a living level, dynamic support. You already know that a horizontal level is a floor with a memory. A rising moving average behaves like that floor on an escalator. In a healthy trend, pullbacks repeatedly sag into the area around the rising line, find buyers, and turn, and because the average climbs with every candle, each touch happens at a higher price than the last. That is dynamic support. Two disciplines keep it useful. First, it is a zone, never a laser line, expect wicks to poke through. Second, it needs evidence, an average this market has already respected twice is worth watching, a random line dropped on a chart is not. The mirror holds in downtrends, where a falling average caps each rally as dynamic resistance. Here's the escalator at work. The trend sets off from 126, and the rising average climbs beneath it, the arrows mark where it sits at each test. First test, the fifth candle sinks to 126.48, straight onto the rising line, and closes back up. Buyers. The rally resumes, then the ninth bar dips to 126.94, the average has climbed 46 pips since the last touch, and again it holds. Third test, the 13th candle touches 127.42. Higher again. 3 touches, each one at a higher price, each one defended. That staircase of rising touch points is the signature of a trend breathing against its own average. The final candle closes at 127.90. And now the most famous signal in all of technical analysis, taught the way it actually behaves, not the way the headlines sell it. A crossover is two averages disagreeing about time. When a fast average, say the 50, closes above a slow one like the 200, recent business is stronger than old business, that's the golden cross, and its bearish mirror is the death cross. The headlines adore them. Here is the honest mechanics, a cross can only happen after price has already moved, usually substantially, because both lines are built from history. It is confirmation, never anticipation. In long trends that lag is acceptable, one cross can keep a trader correctly positioned for months. In sideways markets it is poison, the averages braid around each other, and every cross reverses within days. Same signal, opposite outcomes, context decides everything. A golden cross story, start to finish. The market slides from 127.80 and bottoms in a 5-candle base, lows clustered around 126.82 to 88, the boxed area. During the base the fast average flattens while the slow one still points down, no signal yet. Then the 9th candle closes at 127.42 and momentum arrives. By the 11th candle, closing at 127.92, the fast line finally crosses above the slow, around the gold level. The golden cross confirms. Now the honest arithmetic. The base low was 126.82, the cross fired 110 pips later. What the cross bought was never the bottom, it was confirmation, and the run to 128.70 that followed it. Now the same signal in a sideways market, watch it fall apart. This whole chart lives inside a box barely 60 pips tall. The 5th candle bursts up to close at 126.94 and the 6th stretches to 127.16, the averages cross bullish. 2 candles later price closes at 126.68, signal dead. The slide to 126.56 on the 9th candle flips the cross bearish and price immediately rallies to 127.14 on the 11th. Bearish signal dead too. By the final candle we're back down at 126.72. And a third signal is already failing. 3 crosses, 3 losses, and not a trend in sight. That is the whipsaw, the default behavior of crossovers inside a range. So if crossovers lag and touches can break, what is the average's best job? Being a filter. A filter doesn't tell traders when to act, it tells them which direction they are allowed to consider. The rule many systematic traders use is one sentence long. above a rising 200, long ideas only, below a falling 1, short ideas only. Entries still come from other tools, structure, levels, candlestick signals, whatever the trader has actually tested. The average simply vetoes half of them before they are even judged. And that single veto quietly removes the most expensive habit in retail trading, fighting an established trend because a market looks too high or looks too cheap. Here's the filter earning its keep. A clean uptrend, price holding above its rising average the whole way. Then the fifth candle, a heavy red bar collapsing from 126.02 to close at 125.66. On its own, that candle screams reversal, and a countertrend trader might leap at the short. But run the filter first. The sixth candle dips to 125.48, straight into the rising average zone marked in gold, and holds. Price never closes below the line, so for a filtered trader the short was simply never on the menu. The trend resumes, and the final candle closes at 127.02, nearly 140 pips above that tempting entry. The filter predicted nothing. It just refused permission to fight the flow. Every honest course needs this chapter, where moving averages stop working altogether. Time for the chapter the gurus skip. Moving averages have one great failure mode, and it is not rare, the sideways market. Markets spend a large share of their life going nowhere, and in those conditions every strength of the average inverts. The smoothing that once revealed a trend now just averages noise into smoother noise. Dynamic support stops holding because there is no trend left to defend it. Crossovers fire and fail, exactly as you saw in the whipsaw chart. And the lag that was harmless in a trend becomes pure cost, each signal arrives just as the range snaps back the other way. An average in a range is not a weak signal. It is no signal at all, dressed up as one. So what do disciplined traders actually do about it? First, they diagnose before they apply. Is the average sloping cleanly, with price living on one side of it? Then the tool applies. Is it flat, with price braiding back and forth through it? Then it doesn't, and no setting will fix that. Second, they accept the lag rather than resent it. A moving average buys confirmation, and confirmation always costs the first portion of the move. Third, they test. A rule that isn't written down and checked against history is an opinion, not a method. And they size small, because no indicator changes the fact that trading carries a real risk of loss, and most retail accounts lose money. Let's pull the whole course together. A moving average is a rolling mean, pure history, smoothed until the direction becomes visible. The simple moving average weighs every candle equally. The EMA favors the recent past and turns faster, at the cost of more false alarms. The 20, 50, and 200 matter because everyone watches them. Attention, not arithmetic, gives those numbers their power. In trends, a rising average becomes a moving floor, with pullback touches stepping higher and higher. Crossovers like the Golden Cross confirm momentum honestly but late, and in ranges they whipsaw relentlessly. Used at its best, the average is a filter. It decides direction while other tools decide timing. And when the lines go flat and braid together, the honest answer is the hardest one: stand aside. And that completes the moving averages course. You can now read what an average actually says. Choose between simple and exponential deliberately, treat the big three numbers with respect but not superstition, ride dynamic support in a trend, judge a golden cross without the headlines, and, most valuable of all, recognize the chop where none of it applies. Your homework: open any daily chart, drop the 50 and 200 onto it, and label the last year as trending or braiding before you judge a single signal. If this course earned it, subscribe and turn on notifications. The next one builds directly on today's filter idea. And the usual close, because it matters, everything in this series is education, not financial advice. No method is a promise of profit, and trading carries real risk of loss. Practice on a demo first. See you in the next lesson.